Hey, it's Paddy Hirsch at Marketplace. So the SEC is still trying to get to the bottom of what happened in the flash crash on May the 6th, and it's taking aim at a number of possible suspects, in this case market makers, and the practice that they have of using stub quotes. So to understand how all that works, what I want you to do is think about a swimming pool. So here's our swimming pool, nice big pool. Here's the owner, Mr. Hogan. Here he is, there he is. Very nice chap. But Mr. Hogan owns this pool, but he doesn't actually do much to maintain it. Actually, he's got a couple of lads to do that for him. And those two lads are Jim, here's Jim, and Tom, two likely lads. And they're pretty good usually at maintaining this pool. And the main job that they have to do is to make sure that there's water in the pool. Okay. Now obviously it's a 6-foot pool. You want to make sure there's about, I don't know, 6 foot of water in it, right? In order to make sure that people want to come and swim in it. And you know, the reason that you want that is because you want people to come and jump in the pool and swim around and have a good time and, you know, all the rest of it. That's what the whole business is about. But what the thing is if you've got a couple of lads like Jim and Tom, these guys can be a little bit, but they can be a bit of a slacker on occasion. Right? And what happens if one day they decide to come in and say, hey, Jim, I tell you what, instead of filling the pool, because it takes forever to do it and it's a real pain, why don't we just like put, you know, I don't know, 1 inch of water in the pool instead of 6 feet? Well, of course, they're not doing their job, right? Well, they are doing their job, though, because the only description of their job is to make sure that there's water in the pool. It doesn't say how much water. It could be 6 feet, it could be 1 inch. So they're doing their job according to the letter of the job, according to the letter of the law. But that's no good to the poor punter who comes in. Poor punter comes in, you know, he looks over the edge and sees that there's 1 inch of water, and he says, well, what's the point in this? Well, there's water in the pool, you can get in. There's not water, there's 1 inch of water. I'm going to be sloshing around, you know, around my ankles. That's no good to me. It's no good to anybody. And that's really what the SEC is worried about when it comes to our equity markets. Because equity markets are kind of like, the equity market is kind of like a swimming pool. All right? And the reason it's kind of like a swimming pool is because you have liquidity. And liquidity is the ability to get in to the environment, the trading environment, and buy and sell easily. It's like this, you know, you think about the equity market as a swimming pool, you jump in, whee, you get in there, and you can swim around, and you can buy and you can sell, you know, whatever stock that you want to. And the way this happens is, we have these guys called market makers involved, and Mr. Hogan, or not Mr. Hogan, in this case, the owners of the NYSE or the NASDAQ or whatever stock exchange we're talking about, they have certain market makers, okay, in their system. And these market makers, in exchange for some special privileges, which we won't talk about now, in exchange for these privileges, these market makers make markets. They guarantee your ability to buy and sell. So if you jump into the market and you want to buy a certain stock or you want to sell it, even if there's no one else in the market with you, if you're the only investor in there, these market makers will make a market for you. They will buy and they will sell. Even if no one else will buy and sell from you, they will transact with you. At least that's what's supposed to happen in theory. But what we've found is that a number of these market makers are just kind of living up to the letter, okay, of their contracts and not the spirit. And what they're doing is they're putting in these so-called stub quotes. So usually a quote is like the quote to buy, like an offer, or a quote to sell. Sorry, a quote to sell is an offer, and a quote to buy is a bid. All right. But what they're doing is they're putting these stub quotes in, which are tiny little fractions. So they're saying, well, maybe our offer might be $6 for a certain stock, but our bid might be, I don't know, 1 cent. All right. So instead of you know, I don't know, 50 cents below the existing price of the stock, they've dropped it all the way down to 1 cent. So this is the market that they're talking about. This quoted market is anywhere between $6 and 1 cent. So what does that mean? Well, that means if there's nobody else in the market with you and you're trying to sell that stock, the nearest quote is 1 cent. So your stock's going to go from $6 or around $6 to 0 or to 1 cent in no time flat. And the SEC has found that is some of the reason that we had this flash crash on May the 6th, is that a lot of these market makers, you know, they were living up to the letter of their agreement. Yeah, we've got a bid and an offer in there. We're making a market, but not really to the spirit, because the market is, you know, you could fly a 747 through it. It's not really a proper market. So they're saying, we want to clamp down on these market makers. We want the owners of the exchanges to get around these market makers and force them to get rid of these stub quotes so that they actually produce real markets, so that there is security in the system. Of course, the reason for that is, if you do want to get in there and you want to swim around and you want to make a market, you want to make sure that you can buy and sell. Because if you can't If you can't do that, if you find that there's a stub quote on the other end of your offer, if you're trying to sell something and all there is a stub bid at 1 cent, it means that your stock is going to go sliding fast. And that's obviously going to leave you very unhappy. And here's the thing, if a bunch of investors looking at certain markets around the world to trade, maybe they look at the New York Stock Exchange or look at the American stock exchanges, the stock exchanges we have here, and they look in and they say, why would I want to issue stock into this market? Or investors might say, why would I want to buy or trade stock in these markets? There are no safeguards. If this is the size of the market that we have, there's no safety there for me. If I get involved in this, I may lose all of my money because my stock value may go to zero very, very quickly. And if they decide that, and they decide not to use the American stock exchanges, the various exchanges we have in the US, well, that could leave us and the SEC and all the people involved in the markets very badly needing a drink.